Hello everyone. In my previous video, we discussed about net present value method for evaluating capital budgeting decisions. In this video, I would be discussing about profitability index method. So we continue with the same example to understand the concept of profitability index method. This example has been used for understanding the NPV method. You can look at my previous videos to understand more about calculation of NPV. This particular sum had two mutually exclusive projects with an initial investment requirement of 1 lakh each. The life was 5 years, the taxation part was 50%, required rate of return 10%, depreciation straight line method, and we use this information to calculate NPV. We can see the calculated NPV in the next slide. Let us understand how to calculate profitability index. In a previous video, we learned how to calculate net present value. So we had calculated for project A net present value as positive 13,730. For calculation of profitability index, we divide present value of cash inflows by present value of cash outflows. In this case, the present value of cash inflows is this. So this is present value of cash inflows for project A. Present value of cash outflow is the initial investment for any project, and in case of project A, the value of profitability index is 1.1373. Now, profitability index is also called as benefit to cost ratio. We can say this is benefit and this is cost. We also say that profitability index indicates return per rupee invested in terms of present value, which means that if we are investing rupee 1 in project A as against rupee 1 in terms of present value, it is going to generate something 1.1373. So we can say that it indicates return per rupee invested in terms of present value. Similarly, for project B, let us calculate the profitability index. We have PVCI as 117,670, PVCO 1 lakh. So our profitability index in case of project B is 1.1767. Now, how do we evaluate project proposals on the basis of profitability index? So the rule is that accept a project if the profitability index is greater than 1, reject if profitability index is less than 1, we can be indifferent if PI is equal to 1. But this is in case of a single project. What will happen in case of mutually exclusive projects? We can see that in this example, project A and project B are mutually exclusive projects. If we accept one, the other would be automatically rejected. In such case, we need to basically rank the proposals from highest PI to lowest PI. So we can see that project A profitability index is 1.13, project B the profitability index is 1.17. This is higher, so we rank project B as 1 and project A as 2. So for selection, we are going to select project B on the basis of profitability index method. Let us look at some concepts. Let us assume we have three projects under consideration: project A, project B and project C. We have been given present value of cash inflows for project A. They are rupees 90,000, 1 lakh, 10,000 and 1 lakh. The present value of cash outflow for each project is 1 lakh. So we now calculate our profitability index. In case of project A, the profitability index is 0.90, 90 by 1. So in case of project B, it is 1.1, and in case of project C, it is 1. So we can say here profitability index is less than 1. Profitability index is greater than 1 and profitability index is equal to 1. So now if we look at NPV, let us try to calculate NPV for project ABC. If we look at NPV, what is the net present value? Present value of cash inflows minus present value of cash outflows. So 90,000 minus 1 lakh, we have minus 10,000 negative. Here we will have positive 10,000 and here it will be 0. 1 lakh minus 1 lakh, it will be 0. Now let us understand this. So can we say that when profitability index is greater than 1, which is in this case, NPV is positive? Yes. When will NPV be positive? When PVCI is greater than PVCO. And when PVCI is greater than PVCO, our our profitability index will be greater than 1. So when PI is greater than 1, NPV is positive. When PI is less than 1, NPV is negative, because present value of cash inflows is lower than present value of cash outflows. So our NPV is negative and PI is less than 1. So when PI is equal to 1, which means that NPV is 0. So there is no benefit, because the benefit to cost ratio is equal to 1. So naturally, when PI is greater than 1, the project is profitable. When PI is less than 1, the project is not profitable. And when PI is equal to 1, we can be indifferent. Whether we accept or reject, it is not going to matter.